What's up, everyone? So, I want to talk about taxes and taxes on your investment. I think I'm gonna take away my Saturday videos and change it into tax videos. It just makes more sense to keep it all into finance. Now, I'm not a financial expert or tax expert, but and before you take any of these advices, please go talk to a tax expert. I'm only giving you some of the tips and tricks of taxes I have done as a millionaire and the basic things you need to know about it. And if you want to know more, just research it. And I'm going to give you some of the basic tax information, like on investments. So, tax on investment and the basic you need to know to reduce your bills. Because one of the biggest ways to invest is to save money on your taxes. And the less tax you can pay, the better you can, well, the better off you be and more money you can save. So let's talk about these taxes. Okay. So investing is fantastic and it's a great way to build your wealth. But the IRS wants their money too. So here's some 5 common types of taxation on investments and what you can do to minimize what you want to owe. So, taxes on capital gain. So, what is capital gain? Capital gains are the profits from sales of an asset. That means share stocks, a piece of land, business, and generally are considered taxable income. Now, how does it work? The money you make on a sale of any item is your capital gain. For example, if you sold a stock for $10,000, well, you sold a stock and profit $10,000. You may have to pay capital gain tax on that. The rate you pay depends on what part, on how long you held the asset before selling. The tax rate on capital gain for most assets is yield for 1 year is 0, 15, or 20%. So capital gain taxes on most assets is held to less than a year correspond to ordinary income rate, which means you kind of want to hold your items longer than a year if you want to pay less capital gains on it. Now, how to minimize it? You can reduce capital gain taxes on investment by using losses to offset the gain. This is called tax loss harvesting. For example, if you sold stocks for 10,000 profit this year, you sold another one for a $4,000 loss. Now, you still lost money, but the good part about it is you lost money and you controlled it and you don't have to pay the capital gain on the 10,000, you pay capital gain on 6,000. And a lot of people do that at the end of the year, and it's a well-known tax strategy. So I recommend you using it if you need to use it. Normally I tell you just hold on to the stocks, and there's plenty implications for it. Before you sell it, make sure you talk to a financial advisor or a tax attorney. Tax on dividends is number 2. Now, what is it? Dividends usually are taxable income a year you receive. Earn even if you didn't receive the dividend in cash. Let's say the automatic reinvests your money into shares. Well, the underlying stock such as dividend reinvestment DRIP, you still need to report it because you need to pay taxes on it. There is a general 2 kinds of dividend, non-qualified and qualified. The tax rate on non-qualified dividends is the same as regular income. A tax rate on qualified is usually lower. It's 0, 15, 20%, depending on your taxable income and filing status. After the end of the year, you'll receive a 1099 DIV or a Schedule K1 from your brokerage, and it'll tell you, hey, how much money is sent and at least $10 or other distribution for the 1099. How do you minimize it? You hold the investment for a longer period of time, and it helps you lower your taxable rate the longer you hold it, and you can do what you call tax harvest losses, and that will help you out in that situation. Now, number 3, taxes on investment in a 401k. What is it? Generally, you don't pay taxes on money you put in to your traditional 401k. While the money is in your account, you pay no taxes on investment gains. Interest, dividend, taxes hit only when you withdraw the money. Remember that. Now, with the 401k Roth or Roth 401k, you pay the taxes up front, but then you qualify distribution in retirement as a non-taxable, or it's not taxable. So you can withdraw from a Roth for free because you already pay the taxes. Now, how it works for traditional 401k, the money is withdrawn at a regular income, like you have a job, in the years you take for distribution. Now, if you take it out before the age of 49 and a half, you have to pay a 10% penalty on top of your regular income. So you need to be very careful.